Okay, thank you everybody for joining. Today we're going to cover succession planning and acquisition strategies. We've done this kind of presentation, if you will, or discussion, probably better way of saying it, at a few franchisor conferences where we've been attendees, and it's been well received and valuable. So we thought we'd like to kind of spread it out to a broader group of people. The intent of this is really kind of get you thinking about today and also the future, and it's kind of the goal of this. So just a couple reminders here. This session is being recorded. We will email it out at the end of probably tomorrow. It will go out. So if you have to jump early for some reason, you will get a copy of it. Feel free to share it if there's folks that you think would have some use for it. Ultimately, if you do have some additional follow-up questions after the webinar that were not addressed during the webinar, you could email us at info@ApplePie Capital email address. There is a Q&A button, a Q&A feature. I typically like to address the Q&A during the presentation or discussion, so that way, it's more interactive is the intent. I think the only challenge that we may have is my cohort in crime, Travis Perrine, who is going to be joining us during this, was kind of stuck in a lightning storm on the runway, and he missed his connecting flight, so he is in air right now and is unable to join. So I'm flying solo. I'd like to be able to get to the questions, but definitely I will answer everything by the end if I'm not able to bounce back and forth. So go ahead and jump in here. My name is Randy Jones. I'm the Chief Revenue Officer and Lending Solutions at ApplePie Capital. I've been with the company since 2017, so approximately 8 years. Prior to that, I had a finance company that specialized in consulting services and financing services for franchisees dating back to 2000. ApplePie Capital actually acquired that company in 2017. In the event that Travis is able to join us at some point through this, Travis is our Director of Business Development. Prior to becoming going to the business development side, Travis was a relationship manager handling loans for 6 to 7 years before kind of converting to business development. He's got a long history in business lending outside of ApplePie Capital. So today we're going to talk about, a little bit about ApplePie. We're going to talk about succession planning, valuation, different methodologies, how to optimize for valuation, and then we'll kind of transition to acquiring existing locations, and ultimately the various scenarios and how to potentially finance those if that's your need. Little bit about ApplePie Capital, what makes us different. We form relationships with exceptional brands. We're very brand specific and focused, and the relationships actually transition, the relationship theme transitions to, at our borrowers. We want to develop long-term relationships with our franchisors and also our franchisee borrowers. 100% franchise focused. Our sales team with whom you'd be interacting is consultative. They take a consultative approach to understand your needs, develop a financing strategy that helps you kind of accomplish your short and long-term goals. And we have our loan products basically fit any stage of your life cycle as a franchisee. I would say we have a specific program called the Recap and Grow for using our ApplePie Core program that really helps accelerate growth, which helps differentiate us from some of the other lenders with whom you may be speaking. So diving into succession planning a little bit. A lot of people think of succession planning just to be on the financial side of the house. And the true definition as posted here for business purposes of of succession planning definition is a proactive process of identifying, developing, and preparing individuals to assume key roles in leadership positions within the organization to ensure business continuity in the event of planned or unplanned departures with the goal of protecting the financial investment. So nowhere in there really ultimately says that it's only financial. The where financial is mentioned is related to your investment. And that's a really kind of key feature to kind of point to think about as you're growing your businesses, et cetera, and how do you maximize your return and protect your financial investment. So with that said, what are key elements of succession planning? And identifying the top talent. Some of you may be one unit franchisees or first unit franchisees. Some of you may be larger franchisees looking to grow and add more units. So trying to find your top talent that you want to kind of promote, invest in mentoring, and making sure that you retain them and nurture them to the ability where they can grow with you. Ultimately, transition strategies, so it can create a structured plan for leadership and ownership changes. So in the event of a first unit franchisee, a 1 or 2 unit franchisee, potentially you are operating the location. Once you get to 5 or 6 locations, you probably don't want to be the operator anymore. And so from a leadership perspective, leadership could mean the owner and or leadership of the operating locations. So thinking through a strategy of management/leadership in the first location, second location, fifth location, 10th location, and building the bench and have a plan for that is probably the biggest step that we see most successful franchisees that transition. They are successful at making sure they've developed a bench of leaders and or transition of ownership starting early. So, contingency planning is a key element of succession. And we have had in several instances, we've had the unfortunate incident of a major injury and or death. And so having certain things in place has to contemplate, the worst case scenario. In the event of a death, do you have life insurance so that way your loved ones, aren't taking on a liability potentially that they may not want? Having, in the event of a long-term injury, do you have staffing in place that in the event that a manager gets hurt, you get hurt, that you have staffing in place where the business can continue, is kind of the idea about this. I would say what often gets ignored in most of the situations where we work with specifically multi-unit owners is having good record keeping of lease agreements, franchise agreements, expiration dates, cost escalations. What do I mean by cost escalations? In your leases, typically have a renewal period. Is there a cost escalation at a certain period when you go to renew? Similar to franchise agreements, if your franchise agreement is going to expire and or up for a renewal period, is there potential that you go under a new franchise agreement that has a different cost structure? So having these in an organized workbook, Excel spreadsheet, whatever that may be, where you have as a reference guide so that way you don't have to read each lease, each franchise agreement that could be different as you add locations, making sure they're on one referenceable place for your use really helps simplify all of this. So why does it matter? Why does all of this matter? You want to maintain business continuity in any of the situations that I've described. Most importantly, you want to maintain customer loyalty. And so by having a strong team, by having a strong management team, that develops a culture and it develops customer or continuity within the customer base. And also your customers and users won't feel a pain or a change in your business in the event that there is a management change, et cetera. Also, and I'll show a little later on down in the presentation or discussion, I will go through, this next bullet point, which is protects franchise value and goodwill, et cetera. I'll show you the impact of this a little bit later in a case study. But ultimately, by having a good team, you are protecting the value of your investment. Also, I would say it's oftentimes when we work with buyers and or sellers, I think many times a lot of people don't really fully understand that the franchisor has the right to approve who the buyer is, and ultimately they can say no if they don't agree with the situation. And so with that, ultimately, if as an owner, you have all of the aforementioned points with respect to the management in place, et cetera, and then a buyer comes in and that management is going to stay, you're giving the buyer and the franchisor comfort that your operations will continue at the level that they were prior to the sale or the transfer. And that's really important key factors for both franchisors and buyers. So there's alignment on making sure you do this succession planning from most of the interested parties. Supports family or internal transitions. Some people develop franchises, for legacy, for family and or, friends that their goal is to pass it on to somebody internal. So the goal of the succession planning, it is to prepare future leaders for that event, but also reduces conflict. If it's known, if it's spelled out on what the thoughts are in the beginning, that reduces conflict at the end when it comes time to make this transition. A live example of a transaction that I worked on starting in 2000, I think 7, we worked with a franchisee that of a quick service restaurant brand. It was an uncle and a nephew. Uncle was the finance guy, nephew was the operating partner. They developed 17, 18 locations. Uncle decided it was time to step out, and there's a seamless transition to the nephew on all of operations and also the financing plan to kind of exit and have the uncle get a return on his investment, and then pretty simple transition. It was a good example of a pre-planned, well thought out transaction that happened over a 17-year period. Strategic growth, and again, I'm going to give an example of the valuation on this, but if your goal is to open multiple locations, somebody needs to be available to think through the strategy and not be bogged down in the day-to-day. And so what a lot of times when folks transition from 3 to 5 units and then from 5 to 7 units, there is a change that as a lender and pretty well known that sometimes a business owner changes or a person that's focused on operations has a skill set and a learning curve that has to happen to be able to create and oversee a business as opposed to operations. So by developing leaders early, having the right people in key management positions allows either the owner or the person that's responsible for strategic growth to truly focus on that without impacting the operations of the business. So kind of at a high level, that's succession planning, probably boiling it down to more actionable stuff. What's my financial capacity? This is when you start to get into kind of your own personal reflection on your financial situation. What's my operational capacity? Should I add units to my network? Is there territory in my current brand that's close enough? So said differently, are you staffed to manage growth within a single territory, or are you going to have to be, if you want to continue to grow with the same brand and your territory is sold out and you want to go to a territory that's 500 miles away, that staffing looks different. And you need to account for that in your succession planning. How do I benchmark against like-size franchisees in my system? Most of franchise or benchmarking is related to financial performance. I think there's the benefit of being part of a franchise network is you have a large group of folks that you can talk to kind of help with mentorship and or bounce ideas off each other. So speaking with them about their staffing plans, what's been successful for people that are 30-unit operators and you're a 5-unit operator, what have they done on the staffing to help you create this succession planning? And then lastly, exit strategy. So that's a part of succession planning. It is not what succession planning is. That's a part of it. That's why I listed it last. Certainly, you kind of want to think of what the end looks like when you start, but it's only part of the succession planning. All the previous mentioned items are in an effort to get you the maximum you can at the exit. So other things that you should think about, more usable, more actionable items. What if I had an opportunity to double in size? And do I have the operational ability and management oversight to be able to do that? What if I open 2 locations at once? How many times have you multi-unit operators or even first-time franchisees had, the goal was to open 1 location at a time, site selection took forever, and then ultimately 2 locations fell in your lap at the same time. Do you have the ability to open 2 locations at the exact same time? That's challenging sometimes if you don't have the right people in place. Unfortunately, you do get a situation where you have 10 great stores and maybe one of them isn't performing as well. So what's your plan to help bring those locations up to speed? Do you have the right people there that can help turn it around and have the time and effort and training programs in place to be able to bring those people up to speed? So then, in my experience, any one of these scenarios could happen all at once. So staffing really and training is how do you work yourself through those situations without creating more problems. And all of that starts in the beginning, not when they're happening. So when do I start? Yesterday. Not being facetious here, succession planning should kind of start in the beginning when you set up your endeavor, whatever it is, and certainly that plan may change. So succession planning isn't something that happens on day 1 and it's set it and forget it. It's something that you would address every year and say, based on where I am today and where I want to be 5 years from now, does this succession plan still align with what my goals are? So it's never set it and forget it, something that you revisit to make sure that you're on track to meet your goals, both long-term and short-term. So with that said, I'll transition to, what are various valuation methods and other topics that we'll cover along this discussion. So just for these are discussion purposes only. Obviously, your performance, the industry you're in, the franchise concept that you're in, will all have an impact on the best methodology and also the multiple used to determine the value. Given that we had 200 and some registrants for the webinar, it was hard to kind of give an example of QSR versus service related versus fitness. And so every one of your industries and or franchise concepts may have a little different methodology to it. So this is kind of a general overview. So most commonly used are these three here. Certainly there's more that would come into play, but there's asset-based valuations. Asset-based means that they're looking at the assets on the balance sheet. Those assets could be whether it's leasehold improvements, whether it's the equipment packages, goodwill, etc., are all things that are referenced on a balance sheet. And ultimately, this is the better methodology for people that have large inventory needs and or large equipment, where the cost of that replacement cost of that, it has a tremendous value. Said on a negative side, a lot of times asset-based valuations are used for distressed businesses that are, think of like a quick service restaurant where the sales are relatively low, there's losses. So the value is typically, the equipment, and it's not the cost of the equipment as though somebody was purchasing a brand new location. It is the cost of the equipment after depreciation. So in other words, if it's used equipment, the thought that we have a lot of people say to us, well, a new franchisee coming into this is going to have to spend $600,000 to open this location. So therefore, I'm losing money. I'm going to list this location for $600,000. It's typically not how it works. It's unfortunately, it's typically based on a discounted value of the assets. Good rule of thumb is post-depreciation. You also see multiples of gross sales. So the business, you got $1 million in gross sales, business may be worth 50% of that, depending on it. So 50% of $1 million, that says that business is worth roughly $500,000. Most common examples that you would see, and what I'll go into a little deeper, is a multiple of seller's discretionary earnings or a multiple of EBITDA. They are different. So EBITDA is a very specific definition: earnings before interest, taxes, depreciation, and amortization. Most of you guys know that. Seller's discretionary earnings are some reasonable add backs that are to the benefit of the seller that a new buyer may not incur. And I'm going to go through some what might be acceptable versus unacceptable views on this, and I'll show you the impact of that. But so really seller benefit versus just true straight line tax return type stuff is most commonly used for most franchise businesses. So what's my franchise worth? I hate to be sarcastic on this, but it's what's the market's willing to pay for it. And a rule of thumb that you may hear as an example, a franchise business that you're in is worth 3 to 4 times EBITDA. That might be true for a single unit owner, but a multi-unit owner with some other things that might result in a higher multiple. So the market is kind of dictating what it's worth. And so some financing options will do a valuation to say, is the buyer paying a reasonable price? At ApplePie, we don't do that. But really ultimately the market and can a person pay that price, whether it's financing or not, is really what the business is worth. Now, to give a little more guidance than that, I'm going to go a little deeper into, oops, sorry. Well, what do buyers want to see? So high level, they want to see that the business will keep making money after the owner leaves and how easily they can run it or scale it. This is the reason why I started with all of the succession planning prior. Like they want to buy the business to know that when the owner leaves, the business can operate, which requires great people and good management. um, the other thing that they're going to look at, depending on who the buyer is, they may want to see that there's additional markets available outside of what's just open, or additional territories that are available outside of what you are, sorry about that, what you are currently, your financials currently represent. Now, proven and transferable business model. Some people think that I'm part of a franchise concept. Of course, that's true, which absolutely is true, which is why we specialize in franchise lending. But kind of boiling that down to your situation. Do you have a good reputation? How are your Google reviews? They will check that out. Do you have a good repeat customer base? A lot of franchise concepts are adding loyalty programs. Those loyalty programs not only help you on day-to-day sales, they also help you with providing information to sellers to maximize your value. So repeat customers are really a good indicator of proven and transferable business model. Clean and legal and regulatory status is kind of a broad topic here. So I boiled it down to probably three of the most important things with respect to a buyer. So when you go to sell, a buyer should be doing a lien check to see if you have liens. Liens could be a loan, it could be a tax lien, it could be several different lawsuits that could potentially file a lien. So they're going to do a check on lawsuits and liens. Ultimately, the goal of them or of that is to make sure they're not inheriting problems when they buy. So many times people think that the only reason a lien check is going to be performed is if there's going to be financing to help finance the acquisition. Some people do pay cash. And if they pay cash, their attorney should make sure that they do a lien check so that way they're getting it free and clear. So making sure your books and records related to lawsuits, liens, you have a clean history there. If you have problems, it should be disclosed. That way there's not surprises. Good standing with the franchisor. And then one thing that kind of gets overlooked on a lot of the acquisitions that we finance and look at is the remaining term of the franchise agreement, the transferability of a franchise agreement, the lease agreement and licenses. If you have 2 years left on a franchise agreement without renewal options, same thing on a lease. If you know that you would like to sell these locations within that period, you might be wise to be proactive to ensure that the term remaining is attractive for a buyer and they're not at risk of the landlord not wanting to renew after it's just been purchased. That's a red flag for buyers. Same thing with franchise agreements. So being proactive, knowing the structure that I related above or that I discussed above, and having a worksheet that tells you when certain things are coming up that you have to pay attention to is the first step. Then taking care of it is what the buyers want to see when you get to that point. Now, kind of pivoting gears to the financial side of the house. What do they want to see related to financials? 3 to 5 years financial statements. If you're not open that long, probably since inception, financial statements means P&L, balance sheet, cash flow statements. A lot of people fall in love with EBITDA. More sophisticated people want to know the cash flow. What is the difference? Cash flow means at the end of the day, how much money can I put in my pocket after loan payments, etc. EBITDA is before all of that stuff. So P&L, balance sheet, cash flow statements are what most people want to see. 3 years tax returns. I added this statement matching the financial statement. So in other words, if I look at the financial statements and I want to compare that to the tax return, are they telling me the same story? And I'll kind of go into it a little further. If they're not telling the same story, what happens? Sales breakdown by location. So this is kind of interesting. Obviously, multi-unit owners may want to sell just 1 or 2 locations. And so being able to demonstrate the sales performance and profitability by location, if you're looking to sell 1, 2, or 3 locations out of 10, is crucial to be able to give confidence to the buyer that there is accuracy in the financial statements. Consistency, and then documentation of add backs. So documentation of add backs is kind of transitioning to a seller's discretionary earnings viewpoint. And I'll go in a little bit deeper into that, but what I'm referencing in these add backs is to kind of maximize what's trustworthy on seller's discretionary earnings. Now, so how do you optimize for a sale? This goes deeper into the financial side. Spoken enough about the people side. On the financial side, your goal is to reduce uncertainty. So anytime there's uncertainty, the transaction gets delayed, the value gets debated more. So if you can reduce uncertainty, it will happen faster and you will get a higher price. Similarly, making sure you can give comfort that a buyer can expect similar performance in the future comparatively to the look back. This also ties to staffing. If key people are going to leave, then what is my confidence as a buyer that I would expect similar results? One thing I added this other bullet point, if you're in the middle of a transaction and time has gone by, a lender's going to ask for updated financials if the buyer needs financing, and the buyer is going to ask for updated financials. So have the ability to generate financial statements quickly and accurately will help keep it moving. You don't want to be the source of delay on a transaction because new financial statements were requested and you don't have the ability to generate them quickly. The tips, remember, they're going to look back 3 to 5 years. Why is that important? Is that, and kind of ties to some of the bullet points here earlier. So let's say you want to sell your location in a year, but you've already done all of your tax returns the 2 years prior to that. So you're like, oh, geez, I want to show a little more income on this so I can maximize my value. So that would show up in the most recent year, but on the look back before those adjustments were made, they're going to see a much different picture. So ultimately, just curing it in the most recent year, it doesn't necessarily give similar performance as referenced above, doesn't really get rid of or give comfort that there's uncertainty. So just remember, there's going to be a look back period, and most recent year isn't the only thing that most sophisticated buyers will look for. Lastly, your accountant may not be your best friend on value. Tax returns and P&L should align, kind of said differently. Don't treat your business like a personal checkbook. Nobody wants to pay taxes. It's not very fun. But at the same time, when you see the impact of what that has on your future value, you kind of need to think twice on whether saving 20 grand on taxes is worth it or not. I don't know, go through some rules of thumb on this and be more specific. So what are acceptable add backs versus not acceptable add backs for you to get a little context on this? So acceptable add backs from a seller's perspective. Salary's fine, net income's fine, pension contribution or 401k contributions, health insurance, depreciation, interest, and amortization. Those are all acceptable add backs. Not saying don't pay yourself. And they're legitimate business expenses that can be provable, that can be added back in a seller's discretionary earnings calculation. What becomes very questionable is travel, meals, personal expenses, groceries, home improvement, childcare, cell phone, and auto. I can't tell you the number of people that I've seen that have had within this bucket right here. Within this bucket right here, I can't tell you the number of people that have $100, $200, $300,000 of expenses in this bucket that are hard to prove and ultimately create a lot of conversation back and forth with both the lender and the buyer. So I would keep all of this out of your financial reporting. Now, what I would say is if you're looking for add backs and or maximizing tax, and I'm not an accountant, but every time you open a location, you can use accelerated depreciation, which would have a much better tax impact, and it's recognizable and allowed. If you're in a position to grow, adding new locations will give you better tax benefit than these, because you're also creating an earning asset. So just throw that out there. All right, now the punchline of all of this. So if I'm a single unit owner, I'm showing the impact of value on the value caused by unclear financials. So in this situation, in all three scenarios, we have $100 million in gross sales. Seller's discretionary earnings fall into this bucket here. It's recognizable, it's allowed. So therefore, you're going to get, and again, this is very dependent on the industry you're in, et cetera. This is probably a little conservative, but to drive home the point, I didn't need to show maximum value. So in this instance, $200,000 times 2.5 gives me an implied business value using seller's discretionary earnings method of $500,000. So this scenario here, scenario number 2, there's $100,000 of questionable add backs. So questionable add backs would fall in this bucket here. The impact to you as the seller in this instance is buyer's going to say, okay, I'll agree that those are add backs, but I'm not going to give you the maximum multiple. I'm going to reduce my multiple by some level, and I picked 75 basis points in this situation. So the result of this, same business, goes from 200,000, I'm sorry, goes from 500,000 to 350,000. Just by throwing noise into the financial statements. So the question is, would you want to save 20 grand on taxes and lose out on $150,000 when you sell? This situation's, I've seen this quite a bit also, where the buyers say, forget it, I don't trust anything that's in those add backs, but I am willing to provide or to give you the max multiple. I'm just not going to give you credit for those add backs. That has a much bigger impact on the value. So that goes from 500,000 to 250,000. So I'm going to dive into here a little bit. This actually touches more on the succession planning, the staffing, more so than that single unit situation. The single unit situation was just to describe the importance of clear financials. This situation here is probably more to describe the difference of a strong management team. So you have a 10-unit business franchisee that has kind of a disjointed management team. It's not scalable. It's a dumpster fire every time a new location's added. So in this situation, kind of same scenario, you'd have gross revenue of $10 million for these 10 locations. I did say that the EBITDA is higher. As just anecdotal. Typically, if you have strong management teams, strong people, it's reasonable to assume you're going to have higher profitability. But the bigger impact on this is the multiple. So people that are looking to buy a 10-unit franchise concept, or 10-unit franchise business, sorry, probably pay a higher multiple for that. Contiguous market, 5 locations, generating more profit. So you could probably expect a higher multiple than the scenario that I had here. You'll also notice that it changed from seller's discretionary earnings to EBITDA. Most commonly for larger transactions, they start to look more at EBITDA as opposed to seller's discretionary earnings. So the biggest impact here you can see is, number one, these businesses are generating more profit each year, but also you're saying this is 5 times 1.6 gives me an $8 million exit. This scenario gives you a $14 million exit. That's a $6 million difference because of good, strong succession planning. It's hard to get to this without the right people on board, is kind of the moral of the story. So starting early with the right people is what drives the value. All right, so on to the next topic here. Like growing via acquisition. There's really there's two scenarios. You're going to buy performing locations, or you're going to buy underperforming locations. But defining performing versus underperforming, simple definition: one's making money, the other one's not. So we'll just keep it simple. Now, the pros of buying performing locations, I won't read this to you, but you have existing cash flow. Financing's easier to obtain. So then you're going to start to see that layered in here are some of the other points that we mentioned in the succession planning. So you as a buyer, now we're pivoting from you being the seller to now you being the buyer. As the buyer, these are things that you're going to inherit and things that you're going to look at. That's why, as a seller, it's important to make sure you've accommodated a buyer. So staff, you have existing staff, less trainings needed, locations are open, you don't have the time suck of negotiating leases, negotiating contractors, and ultimately the ramp up period, depending on your business model. Some businesses ramp up longer, some don't have a ramp period at all. So you've taken away a lot of that unknown. Many times you can buy these in multiples, 2, 3 packs of 10, as opposed to one off. So you can scale quickly in this situation, again, depending on your people. Some of the cons, the ROFR of, meaning the franchisor right of first refusal, wouldn't necessarily say it's a con, it's a reality. The franchisor many times has the right to buy this first. And so making sure you're following the franchisor's process on either buying and or selling would help streamline this. Things that you have to look out for if these are aged units, is a franchisor mandated equipment upgrade needed? Is a refresh needed on the look and feel of it? You're going to want to make sure that you've accounted for that and either in the financing package and or in the purchase price. You just need to make sure that those things are accounted for. Deferred maintenance, most of the times if they're performing locations, deferred maintenance isn't as big of a problem because they've taken care of the units. Hence the reason for performing versus underperforming. But it is something you need to consider. Again, making sure you're assessing, the reputation within the community, and does your culture fit your existing culture? Does it fit the culture that you're inheriting? Pivoting gears here to distressed. I've worked with several franchisees in the past that ultimately had distressed units, or bought distressed units and turned them into highly profitable machines. Bought it at a lower value or lower cost, significantly improved the value. So it can be done, and it's definitely something that's executable. But it is something that you have to monitor because of the negatives. You're going to have operational losses in the beginning. Do you have the right talent and team to turn the locations around? Remodel requirements, a lot of times the deferred maintenance on these is a little bit higher because they're losing money and they haven't taken care of the location, or they're losing money because they haven't taken care of the location. So deferred maintenance a lot of times is something that pops up. And a lot of times these are negative impacts in a distressed situation. So do you have the wherewithal to turn this around? So, this is, I can get into financing. When you're financing, existing locations and they're performing well, most lenders require 10 to 20% down payment. A lot of times that's a combination of seller's note and cash. We, as ApplePie Capital, I mentioned the Recap and Grow program. We can use your existing equity and your existing businesses, to help with accomplishing 100% financing. What you got to understand, what will be looked at from a lender's perspective is what is what does your global picture look like, including your existing locations plus the new locations added together? Does that look like it's going to be a profitable situation? Review all the leases and expirations dates. When you have a lender, this is really important. They want to make sure that there's continuance of the income. If there's lease shortage, then they're going to ask that either be renewed as a new lease and or renewal options, extended out almost to the life of the loan. Every lender is a little bit different on that, but I would make sure that you've addressed the lease situation ahead of time as opposed to reactively. This right here is probably the single source of delay on our closings, our short lease terms. You want to make sure you've addressed and the lender knows about any capital expenditures, said differently, equipment upgrades, etc. For businesses that have, like I can think of several businesses that we work with that gift cards are or prepaid services are a big part of their business. So making sure there's alignment on the value assigned to that, what's going to happen and when it's going to be trued up between buyer and seller should be outlined in the buy-sell agreement. We'll actually go up to 4.5 times debt to EBITDA. Some lenders are down to 3 times. We're pretty aggressive at 4.5 times. SBA lenders don't really have this requirement, but they're going to have a third-party valuation that you'll have to deal with. Looks like a question just came in. Should official travel or staff to franchisor require conferences and training be acceptable add back? Yes, I would say yes, that is an acceptable add back. I would say one thing that is debatable on training is, in theory, that could be recurring. And so if it's a one and done, so you just opened a location and that staff needs to be trained, you could consider that a one-time expense. But if every year you're either adding locations or you as a manager / owner want to send people to the franchisor training, that could be potentially considered recurring. So making sure you just have documentation of it and explaining it, and then that can be negotiable. So there are some things that are negotiable, and as long as you have documentation of what the use was, then you've had the support that it needs to have the conversation. If there isn't support, then sometimes this would be kicked out. Hope that helps. And then last slide here. You know what, buying distressed locations, a lot of times you're going to pay for this with cash. Just that's sheer reality. Lenders don't really want to step in and finance distressed units, especially if you're a 1 or 2 or 0 unit franchisee. If you're an existing franchisee and or a well-performing smaller franchisee that has the built or equity within your current operations, a lot of times you can use the equity that you've built up with your current operations through our Recap and Grow program to help finance this. But the losses of the location that you're buying would be factored into your global picture. So yeah, either have to have the equity that could be cash and or pent up equity within your business, but to get standalone financing on an underperforming location is challenging. Underperforming could mean sales and or EBITDA. If it's underperforming because of sales, that is really hard to fix. If it's underperforming but has similar sales to your existing locations and it's more of normalizing expenses. What do I mean by normalizing expenses? You run your location with 30% cost of labor. The seller's running their location at 40% cost of labor. You're in kind of similar market. There could be justification for making changes and adjustments to expenses. But what's really hard to fix in that scenario is low sales. If the unit is just struggling in sales, that's hard for a credit team to get comfortable with what assumptions to put in place. And I think I've covered most of it. Travis, I see you joined. Thank you. I let the group know you wouldn't be able to be here. Hope you made it safe. Looks like you're at the hotel, so thanks for joining. I'm not sure if you want to add anything, but we could turn it over to the Q&A if it fits.
No, nothing to add. I'm here for the Q&A, but thanks for Thanks for taking care of it, Randy. Sorry I couldn't make it in time.
Hey, stuff happens. I get it. Um, so turn it over to the group. If anybody has any questions, feel free to fire away in the Q&A period here. Hope you found this helpful. A question came in. Are you able to send out the foils for this presentation? Foils, I'm not sure what that is. We will send out the deck and the recording if that's what foils means. Okay. Any other questions? Either have a shy group or I covered most of it. Can you elaborate on why auto is not a reasonable add back, how to value intangibles of a franchise? Okay. All right. So elaborate why auto is not an acceptable add back. I'll give you a good example. Real true situation. A QSR business that I was working on prior to kind of transitioning to ApplePie Capital. The motto of that business was fast. The person bought a Porsche because it was fast and said that this is a legitimate business expense because it meets the branding of our franchise concept. So that would probably be an unreasonable add back of an expense. Now, if you're in a business that does have delivery, some of your home services need a truck that is a legitimate business expense, then yeah, absolutely, an auto is legitimate. When you start to pay for your 16-year-old daughter's auto, because she just turned 16 and you want a business deduction, that's when it starts to cross gray area. How to value intangibles of a franchise. So intangibles, for people who don't know, an asset is touchy-feely, right? So a tangible asset is the equipment. An intangible asset would be the franchise fee. It would be kind of goodwill. And so the value of the intangible on goodwill really is the multiple minus the asset value. So if we had a business that was based on a multiple of $500,000 and your assets were worth 200,000, the intangible asset or the goodwill would be worth the difference. So 500,000 based on a multiple minus the hard assets of 200,000 would give you the intangible asset or goodwill of 300,000. What is a typical EBITDA multiple? So again, this, Travis, sorry, I see that. So ultimately, what's a typical EBITDA multiple for 1 to 3 units? It's a broad range without knowing the franchise concept, et cetera. And each franchise concept and industry has different multiples that are pretty well known. But I would say a good rule of thumb, without giving you a vague answer, multiple on EBITDA, again, is different than seller's discretionary earnings, just so we're clear. But I would say a good rule of thumb is 4 to 5 times, depending on the franchise concept. It might go down to 3.5 and up to 5.5. Are your fees set or vary? So our fee for ApplePie Capital, we have a fee to do the loan. That is set based on whether it be the franchise concept, the use of proceeds, and the loan amount. So there are several factors on the fee tier, but they are set for consistency purposes, but they're not always the same. It depends on the situation, the use of proceeds, and the loan amount, and the brand. Most of your franchise transaction, single transaction to one owner, selling locations one at a time over a longer time period. I gotta reread that. Are most of your transactions with multi-unit franchisees oh, okay. So the question, I'll just restate the question. So what the question is asking, the transactions that we see for a multi-unit franchisee that is selling locations, do we typically see them as a group sale or one-off? I would say it's all over the board. It's probably 50-50. There's probably no rule of thumb related to that. You probably maximize your value if you sell as a group versus one-off. But there's no right or wrong answer to that. We see it both ways.
Especially if you have a contiguous region. That's way more attractive if you can draw a circle around your territory and you've got all the white space in that market. That's going to help your multiple a lot too.
Another question. I just got a loan 2 months ago for my first store opening. About how long should I wait for my second and third store? So there's two answers to that, kind of leading. The first answer to the question would be, are you staffed properly to transition from one location to two or three? So that's more of operational efficiencies from a lender's perspective. Depending on the situation, uh, there are business models that have kind of recurring revenue through membership based. And so we may lean in a little bit earlier in a situation like that, where we may lean in 3 to 6 months after the first location is there, as long as the membership is there. Or if the location is open strong, it's not a membership based model, and there's reasonable comfort that the business is generating good profits, we would come in a little earlier. Some lenders want to wait a year or two before they'll entertain financing it. So two answers: operational, you need to make sure you're set up properly. And then from a lender's perspective, it varies by lender. Next question, does ApplePie act as a lender only or get involved in brokerage? Buyer said, we do not operate as a business broker. If you're interested in, we work with a few that are high quality franchise business brokers that specialize in this. Specific question was QSR, that we could kind of direct you to. You can just shoot us an email at the info at that's or even the loans at that's showing on the screen. Next question is how do we have meaningful financial and staff related discussions with a potential buyer while keeping potential sales secret from staff, NDAs, etc.? Good question. So the buyer doesn't necessarily need to have access to your staff during the negotiation. Your job during the negotiation is to demonstrate that you have training protocols in place. You have a training manual, you have all the things that you've developed for your business to give that buyer confidence that what they're buying, the staffing is at a level that they would expect and what you've developed. So once it becomes a transaction where you're ready to reveal it to your team, I don't recommend revealing it when the transaction's done. You should prepare them for it and make sure that they understand that some owners want to do diligence on the buyer to make sure they're a good fit for a team that you've grown to like and love. And so sometimes you're evaluating a buyer as a seller to say, is this a good personality fit for my team? I don't want to turn my team over to somebody that's not a good fit. Is there a best practice to structure multi-unit entities for franchise? So sorry, I didn't read the full question. So is there a best practice to structure multi-unit entities franchise portfolio to make it easier to get financing? Question A. Or B, to make it a more attractive structure from a lender's perspective? I feel like in the past, we've missed out on financing because each entity was its own LLC and didn't show cash flow for years in business. This is 100% lender dependent. Every lender's going to give you a different answer. I would say in the event on the latter point that you stated, that ultimately says, I feel like I've missed out in financing because the most recent entity didn't show cash flow. If you're only giving the lender the ability to cross collateralize or cross guarantee the most recent location, that could be problematic. But if you're telling the lender, like, listen, you can use my entire structure as a guarantor, the most recent location shouldn't matter. It should be the global view. With that said, if that most recent location and you only have 1 or 2 locations open as opposed to 15, then that's a big difference. So it's also situational. So 1 or 2 locations that are performing, the next one that just opened isn't performing that great. That's a different scenario than somebody having 15 locations where one that's recent is kind of just ramping up. So it's situational dependent. One thing I will put a plug in for ApplePie Capital is we don't have to have a cross corporate guarantor from your existing entities. We don't need a lien on your other entities. We can do a standalone loan, which makes us unique comparatively to some of the other players that finance multi-unit franchisees. What are the requirements for lending to someone looking to purchase an existing franchise? So typically what we as ApplePie Capital would look at, our minimum down payment is 15% down. With that, if you went to 15% down, that would be a 25 basis point increase on the interest rate comparatively to 20% down. So if you put 20% down, that would be our down payment requirement without triggering a slight rate increase. That can be split between owner or seller financing and buyer. Typically, rule of thumb is as a buyer, you should come in with 10% equity into the deal. That equity can be from your cash and or embedded equity into your current operations. We do have a maximum leverage ratio. I hate to be banker talk, but if you're buying a location at 4 times EBITDA, then that conversation applies. If you're buying at 7 times EBITDA and 20% down results in a loan that's 5.4 times EBITDA, we would have a max loan of 4.5 times EBITDA. So we look at 2 things. We don't want you to be over leveraged when you buy an existing location. And so we either look at down payment as a percentage of the purchase price or a max loan amount based on EBITDA. Sorry, that's a little confusing answer. If you want to email for greater detail on that answer, you could go ahead and email down here and we could have a phone call to describe the difference a little deeper. All right, I think we're 11 minutes over time, but I appreciate the questions. Look like most people kind of stuck all the way to the end, so thank you. Appreciate the attendance. Hope you found this valuable. We will again be sending out the recording, also sending out the deck probably tomorrow. If you have folks that you think that this would be valuable for, please share that with them, and we'd love to talk to you in the future. Thank you.